The topic we are doing is topic 5. So we are doing topic 5. So topic 5, basically, this is a restructuring of those organizations that are financially distressed. Those companies which are going through financial challenges, how do we get to restructure them? And if I remember very well, in our last class, ladies and gentlemen, we introduced what we called unbundling. Are you able to remember unbundling? Yeah, to make the company become more efficient. We looked at various methods here. For example, I was able to introduce to you what we call a spin-off. What we called a spin-off. Anybody who can remember how we defined a spin-off? Yes. Yeah, you form a new company and then you spin the shares of this new company to existing shareholders. So in this case here, we are spinning everything round and round and round. At the end of the day, there are no shares of this particular new company that will go to outside investors. So basically, under spin-off, as we are unbundling, as we are trying to break off our organization, we shall be able to create a new company, and in this new company, we ensure that these shares are given to the existing shareholders. That is really good. Then we spoke of what we called a sell-off. Are you able to remember what we said a sell-off is? Sell-off. Using the previous class, yes, I'll be able to provide that. So for a sell-off, what do we do? Unprofitable? No. Good, but there is a specific definition, yes. Okay. Now, for sell-off, what we said, if you can remember very well, we said again, we're going to create a new company from an existing company. But now for a sell-off, we sell all the share of this new company to outsiders to raise money. And then we went ahead and spoke about a carve-out as a quick way of recap. A carve-out. So under a carve-out, what we said is that we shall create a new company. Is that okay? But this time around, we're not going to give out everything like it is in the sell-off. Under a carve-out, we shall be able to retain some shareholding of this new company. So you could retain like what percentage? 60%. And then to be able to get ourselves out of these financial challenges, we sell the other extra shares. Now 40% will be sold to outsiders. But under carve-out, I repeat, we shall be able to create a new company. And once we create this new company, we shall retain some shares of this new company. We sell off, in this case here, a few to outsiders. Thank you so much. Then we went ahead and looked at management buyout as a form of unbundling. So management buyout, what are you able to remember about management buyout? Yeah, in this case here, our company, this company of ours will be acquired by who? Existing managers. And then we are both off as directors, we are both off as directors, and then we shall be able to remain with other sectors, if you are a conglomerate company, which is different from what we called a management buy-in. A management buy-in, we said that we shall have what here? External managers now are coming in. Thank you so much. So today, in the next 30 minutes or so, we are going to see the impact of financial reconstruction on two things. So give me those things that I was skipping last time. In the interest of time, we never had enough time. So today we are looking at, so you can write this as a great title there, effect of financial reconstruction, on WACC and the share price. Effect of financial reconstruction on WACC, effect of financial reconstruction on WACC and who? Share price. Effect of financial reconstruction on WACC and the share price. So the online ninjas, have you been able to write down this heading? The online ninjas, effects of a financial reconstruction on W what here? ACC, and what we have called what here? The share price. Great thing, great stuff, great stuff, great stuff. Let me just increase my lens. All right, great stuff. Yeah. So then the first thing that I would want you to, first of all, appreciate is the meaning of financial reconstruction. We spoke about this in our last class. So whenever you hear about financial reconstruction, what comes to your mind? You're changing ownership. No, no, no. You've touched so many things. Ownership, ownership alone. Because remember, when we do financial reconstruction, ladies and gentlemen, we are doing a debt equity what year? Swap. Yeah. So in this case, of course, the owners, then the equity holders will reduce or they'll increase. They'll increase. So financial reconstruction, ladies and gentlemen, is when you are making changes to the capital structure of an organization. So in short, because you have the notes, we are saying there that financial reconstruction equals what here? Financial reconstruction equals changing a company's capital structure. A company's capital structure. That is what we call financial reconstruction. Now then, ladies and gentlemen, there is what we call risk management. We must be able to look at what we call risk management. Because you see, we are going to increase debt or reduce debt. So the risk will be, in this case here, changing. And that is why I would want us to take this opportunity, first of all, to define the meaning of the word better. Mention there, better. Mention there, better. Or I mean, we pronounce it as bitter, not better. Bitter. So what is bitter? Is there somebody who has ever heard of this word before in financial management? In financial management, what does this bitter represent? Or I put up a present for grabbing and then people will be able to get it. So beta is a measure of risk. Which type of risk? Tell us there that beta is a measure of systematic risk. Beta is a measure of systematic risk. Is a measure of systematic risk. Systematic risk is the risk that is uniformly distributed, that is uniformly distributed in an economy. I.e., it can't be reduced. It cannot be reduced through portfolio formation. It cannot be reduced through portfolio formation. It is always uniform. It is always uniform. Very, very important, because that is what beta risk is coming to measure. This is what beta risk will be measuring. By a diagram, just a simple diagram, ladies and gentlemen, we have two types of risks. The other risk, you're not concerned with it. It is not that tough. We have two types of risks. So we have this risk that we shall be calling systematic here. Systematic risk. And then we have the other risk, which is reducing, which now we call what here somebody on systematic risk, which is reducing, and systematic risk. So remember, this is a risk. And then we have here what we call number of securities. Number of securities basically is our portfolio. Number of securities basically is our portfolio. Like that. So the most important thing is for you to appreciate this fact that we have a risk in this case here that can never be mitigated. We have a risk that can never reduce, which is uniformly distributed. Even if you increase your number of securities, that risk will always be there. It's called the systematic risk. It cuts across all sectors of an economy. You cannot run away from it as an investor. And this systematic risk is what is measured using beta factor. Measured using beta factor. It is what is measured using what we call beta what? Yes, somebody? Beta factor. Very, very important for you to know this. Yeah, yes. Yeah, risk in this case here beyond the firm's water control because it is uniformly water distributed. You cannot in this case here reduce it. It is beyond your control. I love that definition. It is that risk which is beyond what here a firm's control. It is all over. All right. I love that, ladies and gentlemen. So go ahead and tell us there that so we have been able to define beta. Again, I have to give you some other definitions which are very important for your understanding of this particular area. So mention there equity beta, like this, equity beta, give me a title like that. Equity beta, give me a title. So tell us there that this measures the risk of shareholders' return. This measures the risk of shareholders return incorporating number one, what we call the business operating risk. Business operating risk, that is number one. And then number two, ladies and gentlemen, we have financial risk. Financial risk arising from debt. Arising from debt. And that is why, ladies and gentlemen, equity beta is referred to as beta equity of a levered farm. Beta equity of a levered what here? Of a levered farm. What we shall be always abbreviating as BEL. Beta equity of a levered farm. So whenever you hear about leverage, what comes to your mind? Debt. Whenever you hear about leverage, debt is what shall always be coming to our mind. So equity beta, this is done. Another definition. In this case here, we have what we call asset beta. Assets beta. Assets beta is also known as unlevered beta. This is also known as unlevered beta. Yeah, so this measures the businesses operating risk, assuming assuming the firm has no debt. Assuming the firm has no debt. Assuming the firm has no debt. So whenever you hear about assets beta, it means unlevered beta. And it shall always be measuring what we call operating risk, this part alone. It doesn't look at what we call financial risk arising from what? From debt. So assets beta and levered beta, this measures the business operating risk, assuming that the firm has no debt. So let's get now to our past papers, ladies and gentlemen. Let's get to our past papers. I know all of us, we have past papers, and I would want us straight away to start with December 2024. Question number 2, cow. December 2024, question number 2, cow. December 2024, question number 2, cow. December 2024, question number 2. So, December 2024, December 2024. Yes, Samsung guy was also asking there, can we say an organization has no control of systematic risks? Yes, it has got no control of systematic risks here. Things like inflation, I'll be able even to define that much better. So December 2024, question number 2C. December 2024, question number 2C. Once you get it, please put your thumbs up like this, or simply there, say Y for yes. December 2024, question number 2C. December 2024, question number 2C. Thank you so much. So we are reading this together. We are told Jamla Limited is considering undertaking a financial reconstruction. I'll be able to get all the marks in this question when I read like that. All these marks, I'll put them in my pocket. I pass. During which it would repurchase its outstanding ordinary shares using debt. This will raise its debt to equity ratio to what here, somebody? 1.8. The following information was available for the company. Existing debt equity ratio is 1.2, which is now raising and going high all the way to 1. What here, somebody? 1.8. I can see assets beta, which is 0.6. The risk-free rate of return is 6%. The return on the market portfolio is 12%. Number 5, debt finance is considered to be risk-free. Number 6, the corporate tax rate is what here? 30%. Now you see they have given me asset beta. Asset beta is what we shall be calling, ladies and gentlemen, BEU. I don't know whether they've been able to finish writing. All right. Yeah. So here the most important concept is for us to know that they have given us assets beta. Assets beta is what we call BEU, like that. Assets beta is what we call BEU. Can you kindly tell me, what do you think does this BEU stand for? Beta equity and levered organization. Yes. So in this case here, BEU is beta equity of unlevered firm. Unlevered firm is also known as ungeared. That organization that has got zero debt. And it's very, very bad to walk around without debt. Even ourselves individually, we must be having lots and lots of what here debt. Are you guys indebted or you are debt-free? Debt-free, that will be very sad. Debt is very good. Debt is very good. Debt is very good. I'm 100% sure that you guys have great amounts of debt. That is why you are here on us, huh? Because you've got no spare money, isn't it? You've got no spare money. Otherwise, if you had spare money, chances are you wouldn't be here. That is the beautiful thing with debt. It ties you up. Now, you see, in AFM, we don't easily work with this beta equity of unlevered because the assumption is all organizations should be having debt. So we must always find a way of changing this beta equity of unlevered to beta equity of what here? Levered. So we are saying here, change change beta equity unlevered to beta equity levered. You can write it in full. Change beta equity unlevered to beta equity levered, because in finance, it's only one scenario where we shall be able to use this directly, only one. But in all the questions shall be doing here in AFM, we don't work, except for that one area, we don't work with BEL. We will always be working with BEL because our organization, so honestly, it doesn't matter how big they are. Even if it's Safaricom today, the other day they raised a big bond, isn't it? Yeah, they have debt. Not unless you're another one. For faster growth, you must always leverage on other people's money to grow. That's why we're calling it leverage. Leverage. But again, remember, as you lever, as you bring up this loan, you must also be financially literate. Like a friend of mine sometime back, aliniambia mwalimu mimi nimepata loan ya 1.8 something, eh? So ilikuwa na tu vitu juu. So alikuwa ananipigia simu ananiambia ati mwalimu, sasa tupatane mahali ati sasa tukule hizi leaves na suckers atibaki at main stem. Sasa sijui kama main stem ni 1 million. By the time inabaki 1 million, utakula kila kitu hizi nini? Utakula kila kitu. Pesa ya loan lazima iingie kwa intended purpose. Haitaki mchezo, hata shilingi moja. Hiyo si unachukua loan za kufresha mama kwa nyumba, hapana. That's very wrong. Maisha yanafaa kuendelea kawaida, so that you can now leverage everything from this loan for the growth now you guys will be able to enjoy in the future. So you change BEL to BEL using a very important model that you did in financial management, which you passed very well, using Hamada's what here somebody model. Please write this, and if possible, highlight. Yeah, thank you very much. I can see very good questions there. Is there any problem of a farm having high gearing? Again, this gearing should not reach where? The throat, because you can easily, in this case here, die. You can easily become what? Insolvent. You can easily become insolvent, and you're going to be getting a lot of mathematics about this optimal debt equity level. Don't, in this case here, go outside, there's a finance manager, and then say that Mwalimu said, borrow and borrow and borrow up to $1 billion. No. You'll reach a place where you'll be auctioned. So this Hamada's model, now that you have been able to write it in capital letters like this, is there anybody who is able to remember it, given that you passed very well last semester? Hamada's model. There are formulas that I would be borrowing heavily from your FM. For example, you know this model we normally shall be calling it the Gachagwa's model. Yeah, Gachagwa's model. Remember, Gachagua was a provincial officer. Do you remember that? Don't write this. I'll be doing it later. So in this case, he was a provincial officer, district officer. So a provincial officer will be a district officer, in this case here, who grows in terms of rank, isn't it? Yeah, district officer who grows in terms of rank. Yeah. And the moment in this case here, of course, that was Gachagua. The moment you mess up with him, there is no Kenya, or rather, it will be Kenya without government, isn't it? Okay. Do you remember this formula? We shall be using it a lot. A lot. We shall be using it a lot. We shall be using it a lot. At least Minikaku, or some of you were exempted. No problem, Harriet. But trust you me, the examiner, Kasneb, will not be able to understand that language. That language of exemption, he will tell you are exempted on the strength of a paper that you did in some university, isn't it? So he expects you to be remembering. Anyway, we are teaching this thing from first principles. You'll be able to understand. So we used to say here that BEL equals BEL into 1 plus debt over equity less tax. Very important formula. Hamada's model goes like this. BEL equals BEL into 1 plus debt over equity. Yeah. Less what here somebody? Tax. Thank you so much, Mike. Anasema Gachagwa's model Kasneb safari hii nitawanyorosha sawa. Wataona giza, isn't it? Yeah. So this is a model you can never go to a Kasneb's AFM exam without mastering it. This model. Just like the Gachagwa's model, the one of getting share price, isn't it? Yeah, you can't tell me that you're a finance manager who does not know how to compute the value of a share. So this is as well very, very important. So then let's read the question. So required. They want us to give them the firm's levered equity beta before and after the financial reconstruction. So if I were you, I know they're asking me to give them levered equity beta, which is the same as Bell, isn't it? So they want me to give them Bell before reconstruction and then Bell after reconstruction. So right there, Bell before reconstruction. Very easy, easy peasy. You underline. You must always underline your values nicely. You underline. So Bell before reconstruction. So let's compute it. Already we have a formula. So we know that Bell then will be equal to Beu. Are you able to see Beu? I'm so sure they are not able to see it. 0.6. Because Beu is the same as assets beta. Beu is the same as assets beta. I can't hear anybody online who is giving me the value of Beu. I can't see anybody. I can only see Mieni. Mieni has been able to know that assets beta equals Beu. And the Beu in this case here, the assets beta given in the question from note number 2 is 0.what here, somebody? 6, yes. So it is 0.6 into 1 plus, are you able to see the debt to equity? So debt to equity, should I use 1.8 or 1.2? Pata potea. Pata potea. 1.2. Why 1.1, not 1.8? Before reconstruction. She doesn't have the past paper. You guys must be nice to this lady. You must be nice to this lady. You must be nice to this lady. She needs to get a past paper. Otherwise, it will not be a very, very good lesson. Okay, so 0.6, remember we are getting before reconstruction. Ladies and gentlemen, the 1.8, if you remember very well, if I read the paragraph from the very beginning, Jamla Limited is considering undertaking a financial reconstruction during which it would repurchase its outstanding ordinary shares using debt. This will raise its debt to equity. So you see now that is raising, isn't it? To 1.8. The following information was available for the company. Existing debt to equity. Existing means what year before? Reconstruction. So existing debt to equity is 1.2 times 0.7. And I'm 100% sure they haven't seen where I got 0.7 from. 1 minus tax, isn't it? 1 minus tax. Tax is 0.3. It is given there. Number 6. Number 6. Thank you so much. The online guys today, they are getting my present. The online guys today, they're getting my I don't know whether I have money, but today they should get some present. Today they should get some present. And today you are very, very few. 48 is not the number that I normally teach. I normally teach AFM. AFM, I should get 250. Were you guys aware of this class today? Were you guys aware of this class today? Oh, they have AFR. Okay. Okay. You should not have allowed me to. You should have allowed me to bring this during AFR's time. No. You would rather have told me to fix it together with the audit and assurance, because audit and assurance is a straightforward paper. Nobody fails, unless you have a problem. Nobody fails in audit and assurance. You can read that on your own. We were actually waiting for AMA starting at 6 p.m. Pious. AMA is starting at 6 p.m. AMA is starting at 6 p.m. So then, are you able to give me this answer? Are you able to give me this answer for Bell? 1.1? 1.104 like that. So you get a mark like that. And then now you go ahead and remember, you must always read the question severally. They wanted us to give them the firm's levered equity beta before and then after what? Reconstruction. So now go straight away and give us a title, Bell after reconstruction. Every other thing remains the same, except for what? The 1.8, the debt to equity after, isn't it? Everything else remains the same. So Bell after reconstruction. Bell after reconstruction. So after reconstruction, ladies and gentlemen, everything, this Bell is shared. Bell will remain the same into 1 plus debt to equity after reconstruction. Our debt increases. Debt to equity ratio increases to 1.8 multiplied by 0.7. So I hope everybody is now following. Thanks so much, Airo Jane. And please, the online guys, at times I know you got internet challenges, but don't wait until we finish the class and then that's when you start saying that, Mwalimu, you're very fast. Always raise questions like now. If you're not able to follow, like other semesters, tell me, Mwalimu, I'm not able to follow. I repeat. Usingoje mwisho sana. So Bell nakuja nakuwa ngapi hapa sasa? 1.356. But I'm so happy today. I can see they're giving me really, many of them are giving me answers. Yeah, so we have been able to answer number 1. Then we go to number 2. Number 2, now they want me to give them the farm cost of equity before and after what year? Financial reconstruction. So they want me to give them cost of equity. Cost of equity before and after financial reconstruction. So cost of equity, again, from your financial management, we have so many ways of getting cost of equity, so many ways you can use to get cost of equity, like the dividend evaluation model, so many ways. From the Gachagwa's equation, you can make that KE the subject. But you see, this is not a question of dividends. Here, the only way out for cost of equity, which in this case here, we normally abbreviate using what here, somebody? KE. We shall use CAPM. We shall use CAPM. We shall use CAPM. Is there somebody who is able to remember what CAPM stands for in full? Capital Assets Pricing Model. Capital Assets Pricing. We shall not assume. We shall always write all these things. Capital Assets Pricing Model. Capital assets pricing what year? Model. Thank you so much. Can somebody tell me, why do you think Mwalimu wants to use CAPM in this question? It's because I've seen risk-free somewhere. There is risk-free. Once you see risk-free, then they want you to use these CAPM skills. But now, are you able to remember the formula of CAPM? CAPM, cost of equity. I may forget, but I'll always remember that it starts with what here, somebody? Risk-free. Remember, CAPM is a model for the rich people. Rich people believe that they must always mix risk-free assets and risky assets. So if you are here, even if you tell me, Mwalimu, I'm very, very rich, and then I realize you don't have treasury bills, I'll write you off. Because everybody who is rich, look at the companies you guys are working for, like the Indian companies. Even if treasury bills are paying a very low rate, they must always be having them. Why? Because the government must always pay, isn't it? Yeah, it's risk-free. Yeah. You can't tell me in this case, you know, the biggest mistake we make, especially we as Africans, because of financial literacy again. Yeah, because, you know, financial literacy is not taught in schools. We learn ourselves in this case here when we are in these things, right? So you'll get somebody in this case here, they get 10 million Kenya shillings. And then they will hear that right now, what is really being spoken outside here by very, very many people, it is, for example, the quails. You remember quails? Those birds, right? And then they go and pump in 8 million, 10 million to quails. And then, of course, the market is flooded. So always, whenever it is CAPM, we mix risk-free assets and the market assets. Market assets have a higher risk, but of course the return will be high. So remember, for the market, then you must give us what we call a market premium. So say ERM minus RF. But now remember, you must come here and multiply with the risk because market assets must be risky. So you multiply there with what here, somebody? Beta like that. Beta like that. Yeah. So then, ladies and gentlemen, I would want you to do me a favor. Please do me a favor. Please do me a favor. Now we have a formula, but I would want in this case here to rewrite this formula a little bit. Remember, our companies have got what here? The debt. So shall be talking of CAPM, cost of equity of a levered firm, KEL, which will be equal to risk-free plus ERM minus risk-free multiplied by Bell. Bell and KEL are brothers and sisters, Yeah, a brother and a sister. KEL. KEL, this L stands for what, Eli? Levered. So then can you kindly do me a favor? Give me this CAPM, cost of equity of a levered farm, before reconstruction. Before reconstruction. Before reconstruction. So basically before reconstruction means what? We shall use which bell? You know, we have the two bells up there. Yeah, the first one, isn't it? So use bell before reconstruction. Use bell before reconstruction. So basically here, use bell before reconstruction. Use bell before reconstruction. Are you able to do it yourselves? Let me see. Now we are plugging in. So is there somebody who is able to see? Thank you so much, Smite. Thank you so much. Milikaku never disappoints. She was able to remember CAPM in full. Hey, you must be able to see risk-free. Risk-free. You must be able to see risk-free. What is the risk-free from the question? 6%, isn't it? So it is 6%. Are you able to see expected return of market? By the way, I never told you this in full, eh? This is expected return of market. RF is risk-free rate. Please, you can write somewhere there. So what is this expected return from the market portfolio? 12%. So 12%, I'm following this. I say minus this risk-free again, which is 6%. But now Bell before reconstruction. 1.104 like that. So please move slowly. Give me this CAPM, cost of equity of a levered farm, just slowly. 12.624%, right? Let me hear it from my online students. My online students are getting like Mieni, some Smite, 12.624%. Thank you so much. 12.624%. Is that okay? So you must have very good titles. Now we have been able to finish CAPM, cost of equity of a levered farm before reconstruction. Now you shall be able to go and do CAPM. Yeah, KEL. But now after, isn't it? After reconstruction, which I believe you guys will be able to do for me very comfortably. After reconstruction. After reconstruction. After reconstruction. After reconstruction. After reconstruction, I'll give you a minute. You try getting it. Even if you don't get it, so what? So what? Nothing. So we have Mieni giving me 14.136. Is that okay? So I repeat, ladies and gentlemen, the formula. CAPM, cost of equity of a levered farm, will be risk-free plus ERM minus risk-free multiplied by Bell. But now remember, this time around, we are using Bell after reconstruction, isn't it? So the risk-free is 6%. Everything else will remain the same, except for the risk profile Bell. Bell now is changing because the debt to equity has changed. And this Bell, after reconstruction, you guys gave me some number. 1.356. So then at the end of the day, we are getting 14 point something. 14.136. 14.136%. Thank you so much. 14.136%. So that is it. So then we go to the last part, ladies and gentlemen. The last part here, they want us to do this thing that is really easy. Everybody will be able to get this. You did this in financial management, either the university or in CPA intermediate level. They want us to give them the wakaka, which is a very unprofessional way of pronouncing it. Wakaka. It's supposed to be WACC, Yeah, when you go outside there, don't call it wakaka, please. And if you call it, don't say that I was your teacher. Hide me somewhere. All right. So they want me to give them weighted average cost of what year? Capital. So number 3, they want me to give them weighted average cost of, that's what they want me to give them. I'll underline. Is there anybody by any chance who is able to remember the WACC formula? Weights, Yeah. Weight, W. Weke. Very good. Weke. Yeah. Weke like this. Yeah. Plus what here now? The other one defeated them to pronounce. Up to now, I've never gotten anybody who can, this is where Kesa. So we have WD, KD, but KD must be after what here, somebody? After tax, yes. So please write this in full, that WE stands for weight of what here? Weight of equity. Weight of equity. And then we have WD standing for what here, somebody? Weight of debt, isn't it? Weight of debt. And actually, I would want you to give me these weights. Please give me the weight. Remember, we are doing this WACC before reconstruction. Can we change something here before what here, somebody? Before reconstruction. So I want somebody in this case here to be ingenious by giving me the weight of debt. Because you see, before reconstruction, before reconstruction, we have our debt to equity as 1.2. From this debt to equity, are you able to give me the weight of debt? Just try, we see. Thank you so much, Mieni. You must be a very good student. You must be a very good student. Debt to equity, 30%. 33. Let me hear from my online ninjas. Let me see my online ninjas where they are kicking this hard. Let me hear from my online ninjas. Just try. When debt to equity is 1.2, what will be the weight of debt? Because we start from there. This has defeated you. Even my online ninjas, nobody's kicking nothing. Nobody's kicking nothing. It has to be 0 point. Weight has to be 0 point. So that weight of debt plus weight of equity must always be 1 or 100%, yes. So it cannot be 3. So it's just like a probability. It cannot be 4. It cannot be 0 point. 0.32. Milikaku is giving me 0. So let me give you a secret, ladies and gentlemen. And I'm so sure you'll always remember me for this. Yeah, this is really nice. Really nice. So whenever you're given debt to equity, you see debt over equity is 1 point what here, somebody? Do you know that every number has got a silent over 1? Every number, whenever you see, every number, whenever if you see 10, it has got a silent. So it means that from this arrangement, debt is 1.2 and the equity is what here, somebody? Equity is 1, as you can see. Is that okay? And then weight of debt, WD, is debt over debt plus equity. That's how we get weight of debt. It's debt all over debt plus equity. All right. So the debt here is 1 point what here, somebody? 2. All over debt, which is 1.2 plus equity, which is what there? 1. So that will be 1.2 over 2.2. You said that. You say 2.2. And that is the weight of debt. So weight of debt will be 1.2 over 2 point what? Which will end up giving me 0.54. 0 point, give me 3 decimal places. Give me 3 decimal places. 54, 55. 54, like that? Yeah. And I will repeat this, not once, not twice, thrice. I will repeat this. So then, having gotten this weight of debt, what do you think will be the weight of equity? The balance, isn't it? Because weight of debt and the weight of equity must always add up to who? Una. Must always add up to 1. So then weight of equity will be 1 minus 0.5455, which will end up giving me what figure, somebody here? 0.4545. So this is the one that I've shown you here is a very useless method. Never remember it. That's a very useless. If you get somebody doing this question this way, that person does not know finance at all. These are actually even right there, very useless method. Very useless method. Because, ladies and gentlemen, one thing that you're supposed to always to know, method 2 here, is that whenever you are given debt to equity as what here, somebody? 1.2. Get in this case here, weight of debt, this is what we shall always do, which we shall always remember forever, always. You take the number that you have, which is what here, somebody. You divide by the same number, which is, but now remember at the denominator, we must always add what here? In the denominator, always, always. You must always add 1. That's how you do it professionally. Whenever a given debt to equity, to convert this to weight of debt, not weight of equity, but weight of debt, you always take the number. You divide by the name, same number, but you add what here? We normally say mark it up by 1. Mark it up by 1. So then this one here will end up giving me what figure, ladies and gentlemen, here? 0.54. To show you that you ninjas, at times ninjas can as well sleep, isn't it? To show you that you ninjas are not following at all, at all. What if the debt, don't write this, what if the debt to equity was 5? What then would be the weight of debt? If the debt to equity was 5, and then they want you to 0. The online ninjas show you are not following at all. If the debt to equity, they are following. They're following. Have you gotten 0.8 something? My brother has not gotten it. You've gotten it? Yes, because it is very easy. You take the number, which is what here, somebody, divided by the same number, but now increased by what here, somebody? So it will be 5 over what here, somebody, which will end up giving me 0. Do you like this method? Yeah. So whenever you're given, because at this level, in financial management, intermediate level, they used to give you weight of debt and weight of equity. At this level, nobody. If they give you that, come, I give you a present. They shall always give you debt to equity, always. They expect you to know how to compute the weights. So now the online, are we okay? Even the online ninjas, are we okay? Are we been able to follow now? Please give me feedback. Thank you so much. Thank you so much. So now here we are. But you see, we haven't yet gotten WACC. We haven't yet gotten WACC. We have taken care of the weight. Now what we need to do is to take care of what? Yes, somebody, the costs. Yeah. So give me the cost. You have it. So cost of equity of a levered farm, which of course will be the one before reconstruction, because the WACC you are getting is before what? Reconstruction. They are up there, 2 of them. So cost of equity before, what figure do we have here, somebody? 12.624%, isn't it? And then KD is always the same. KD doesn't change, eh? KD is always the same. So remember, this is cost of debt. It doesn't change. Cost of debt will remain the same. So cost of debt in this question, can a student in this case here read for me the cost of debt? 6%. How did you know it's 6%? Oh, yeah. Yeah. So this examiner was a little bit lenient. He told us that cost of debt equals what here, somebody? Risk-free rate. Good examiner who will be able to go to heaven. Most examiners at this level can never tell you such a thing. It will be upon students to always know that nowadays these banks can't give you unsecured loans. Banks in this case here will give you loans that have secure collateral. And because of that, then debt does not have any risk for the bank. So in short, KD will be equal to risk-free rate. So you're saying there that KD equals a risk-free rate, which they have told us is what percentage there? 6%. Now, do you have everything which can enable us get this WACC? Now we have everything, isn't it? So please go ahead and compute it. Go ahead and compute this WACC that I would write here, the WACC. So you see the weight. So we have the weight of equity. You had given me the weight of equity as 0.4545 times cost of equity before reconstruction. You guys gave me 12.624%. Plus weight of debt, you guys gave me 0.4455 times KD, which is 6%. But this KD must be after what year? After tax. Because of the 1 minus T. 1 minus T. I'm following this formula. I'm following this formula. This is the formula I'm following. This is the formula that I'm following. That is the formula that I'm following. So then this one, at the end of the day, will end up giving me what figure? So please, every Sunday we shall be able to know now how do we incorporate these students who have AFR at this time. But always you shall always know, that I don't miss my classes. 8.028%, isn't it? So I don't miss my classes. I don't know. I don't miss my classes. I don't miss my classes. Equus Kugan, even my wife knows I have two wives, herself and RCM, isn't it? So you'll always get me here. Always. You'll always get me here. You'll always get me here. So is this answer correct? The answer is correct, right? So then we come and calculate the WACC, in this case now after what here, somebody? Now I think I've given you so much. After reconstruction. If it's WACC, I know I have the issue to do with what here, with weights, I have the issue to do with weights. And for me to get weights, I would want you to give me the debt to equity ratio. Debt to equity ratio after reconstruction, if you remember very well. It was 1 point. Now, without you guys thinking or even winking, it doesn't matter. Can you kindly give me the weight of debt here? Let me see. Let me hear. The online guys haven't yet given any number. The physical guys have been able to give me a number. Weight of debt. Airo Jane has given me a number. Mary Ann has given me a number. We have an A. Harriet has even given me the method. Harriet has told me, we know weight of debt. Whenever you're given debt to equity, take this 1.8 divided by the same 1.8, but for the denominator, it has to be marked. So what this lady is telling me is that I should take 1.8 divided by 2.8, isn't it? Which will end up giving me what figure? 2.9 or 2.8? 2.9. And once I have weight of debt, then I will be able to get weight of what here? Equity. Those are free marks. So weight of equity in this case will be equal to what? Please give me an answer. Because the two must always add up to 1. So weight of equity will be 1 minus 0.6429, which will end up giving me what figure? 7.1, isn't it? Now, out of this, do you think you can easily give us the WACC after the construction? The only thing I need is the KEL after the construction and the formula, because I know my WACC will always be equal to weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus what here? T, like that. So the only thing I need is the KEL after the construction. Now I have everything. So my WACC will be equal to weight of equity. I already have it somewhere. It is 0.3571. Are you able to remember the KEL after the construction? 14.136, percent. Weight of debt, I already have it. It is 0.6429 times cost of debt. Cost of debt, ladies and gentlemen, what do we have as cost of debt? It is at 6%, isn't it? Times 0. What here, somebody? 7, because our tax is 0.3. Our tax is 0.3. Our tax is 0.3. So 1 minus 0.3 gives me 0.7. So I would expect some answer from my online ninjas. What figure are they able to give me? I can see Caroline giving me 7. What here, somebody? 7.8? Oh, Caroline, your figure is different from what Rose has given me. Who do I trust now? And both of you are ladies. So in this 7 point, 7.748. 7.7, like that. 7.748. Walter Omwega, you have 9.8. It's too high. You must have missed out on some abracadabra to do with what we call body mass, isn't it? Yeah, because you'll get some students saying, then they multiply everything with 0.7, and that 0.7 is supposed to touch only that other term. So just move slowly. So what are you able to observe from your WACC? WACC has reduced, isn't it? And because WACC has reduced, we recommend reconstruction. Because anything that reduces cost of capital is good for the farm. So WACC has reduced from this to this, and oh yeah, We recommend this reconstruction. We recommend reconstruction. We recommend reconstruction. We recommend reconstruction. This will always come in your exams. Always. This one here. And I would want to give you an assignment that we must always do before we meet, isn't it? April 2022, question number 4, dog. I'll not give you 2 questions. I'll only give you 1 question because I also appreciate that you guys have other responsibilities. So if it's only 1 question and then you don't do it, there shall be a punishment. April 2022. April 2022. Yeah. April 2022. Question number what here? 4D. So if you don't do this by our next class, the punishment will be very, very good. I will not send you to bring your parents because you told me that yourselves are parents. So what I'll do, I'll simply go to that hotel where they don't allow people to eat by their bare hands, and then I'll send the bill your way, right? It's called a fine restaurant, right? So 7,000, 8,000 for dinner. Otherwise, thank you very much. It's been a pleasure hosting you. I'm looking forward to meeting you in advanced management accounting. Cheers.